Hello, this is Hall Martin with Investor Connect. Today we're here with Daniel Carter of Windmill Investments. Daniel, thank you for joining us.
Good morning, Hal. Good to talk to you.
Well, good. Well, just wanted to learn more about your background and what Windmill Investments does. It seems like you have quite a track record in the Texas real estate market, but first maybe you can tell us a little bit about yourself and how you got into Windmill and your background.
Great. Yeah, I'd love to. So, I grew up in real estate. My dad was a broker and a rehabber. So, when I was a teenager, my mom would send me after school to go help my dad, blow insulation, pull wires, paint, roof, whatever it was. So, I pretty much had real estate in my hands from the time that I was 9 or 10 years old. So, for me, it was real estate feels really natural. I grew up with it, whether that's looking at the rehab on a property or whether it's understanding the fundamentals of what makes real estate a good investment. And that's not just improving income and creating value, but it's looking at expenses, managing the cost structure, etc. But when I was young, around 13, 14, there are a couple things that were key to me. One was I was never asked by my parents, am I going to go to college? It was always, where are you going to go to college? And it was never asked, what are you going to do in life was always a question, but it was more implied, when are you going to start a company for yourself? Because my dad was a serial entrepreneur and that was always my goal. But when I was 17 and went to college, I wanted to get some experience in another company other than my dad's. So I studied computer science, was recruited to go to work at Microsoft back in the early 80s. If you can imagine Microsoft at 350 people, I was fortunate enough to be able to start out in just a really, really good environment. And, I was employee number like 354. So it was very early. A really, really good group of people that challenged me to be the best I could be. And that's what I was looking for in my first job. I stayed at Microsoft for about 5 years, and I was doing real estate on the side. So I bought my first investment property when I was 22. It was a little condo about a half mile from Microsoft's headquarters. If you can imagine, $2,000 down in Seattle, $2,000 down, $42,000 property. That property is now worth well over $500,000. But along the way, I left Microsoft after 5 years, started my own company, grew that up to about 50 people. And I ended up meeting a foreign girl who ended up being my wife. And we met each other 37 years ago in Corvallis at Oregon State University. So my first company I started up in Amsterdam, and it was a technology service company for American companies. And so I spent quite a bit of my time, and I still do spend quite a bit of my time in Europe and in Amsterdam. But we sold that company in 2004. And that is when I went into real estate full time. And I don't know if anybody remembers back, 2001 to 2004, 2006, I guess, was pretty good times in real estate. So we built up about a $15 million portfolio at the time. And it was mostly smaller properties, under $5 million dollar acquisitions. But in May of 2006, we were looking at the market and we anticipated the bubble. And whether that was from being smart or being lucky, I'd rather be smart than lucky. But I think we're a little bit of both. But we looked at the market in May of 2006. We quit acquiring. And we started selling some of our assets. So we came out of the housing bubble and the recession quite well. We went into it with a lot of cash on hand. And in 2011, we started buying as much as we could. And it was 2011 that we started looking at Texas. And the reason that we looked at Texas is that Texas was really the only state that had economic growth, population growth through the recession. And Texas slowed down, but not nearly as much as the rest of the nation. And Texas was, I think, the first state to really come out of recession back then. So we started in December of 2011 acquiring some value add properties. And I'm going to call our strategy strategically opportunistic, in that we have a very distinct strategy that we're following. but we're also looking for opportunities, or we're willing to look at opportunities that are a little bit outside of what would be a typical strategy for us.
And what is some typical examples or criteria that you look for, just at a high level? What do you look for?
Well, the first thing that we look at is we're looking for the market. So we're looking at a market that's got economic growth, population growth, family creation. And if you have those factors, then you're going to have income growth, which is going to create value and make it a pretty secure and let me say, it's safer environment for investing. So we're trying to minimize risk and get outsized returns. So, for example, our first large acquisition in Texas was in San Antonio. And San Antonio is not the hottest market in Texas, but it's a nice, stable market. And at the time, prices were low, rent growth was strong, and there wasn't a lot of construction in San Antonio. And that gave us the opportunity to buy fairly well. We were buying at 8 caps. And if you're a real estate investor and you're talking about buying, Class B or sometimes even Class A properties at an 8 cap, that's an amazing price. It's very inexpensive. So, if you have population growth, job growth, family creation, that means that there's demand for additional rental units. And that's the key factor that we look for. So what we liked about San Antonio was that Houston had really cheap prices, but it has a lot of risk. San Antonio was a safe market, had rental growth, had a dearth of construction, so there wasn't a lot of supply coming into the market, and the 3 to 5 year projections for San Antonio were really strong. So I think our first 3 acquisitions in Texas were actually in San Antonio. And so that's what we're looking for if we look at a market. Now, within San Antonio, we then looked at, well, what markets do we want to be in? What markets do we not want to be in? And there are areas in San Antonio that have stronger growth, that have more demand than others. And so we focus on particular neighborhoods. And typically what we say is we're looking at about 5 different neighborhoods in a particular market, and then we'll focus down to the streets and the blocks and then the properties and try and find underperforming or undervalued assets in those markets. So our first acquisition in San Antonio was right across from the USAA and about a mile from the medical center. And both of those are strong economic drivers, and there wasn't a lot of construction going on in that area. And so those are the things that we're looking for in a neighborhood. What we look for in a property is, what I just mentioned, in underperforming or undervalued. And typically they go hand in hand. So an underperforming property can be a seller that might be tired or older, that's just simply feeling safe, not raising rents, trying to keep occupancy at 98 or 99% by keeping rents $50 or $100 under market. Those are great assets because you can basically go in the door, you can raise the rent the day after acquisition, and it's a management play. There's not a lot of capital expenditures necessary to create value. It's bringing in better and more aggressive management will do that. We don't shy away from putting money into properties if we can see that the return is there and the value is there as well.
So aside from raising rents, what do you do to reduce costs or to increase revenue? Are there other things going on aside from just the rent?
It's interesting because it's an interesting philosophy. Our philosophy is we're going to focus 80% of our effort on income and 20% on costs. So we will try to control costs, but you can only cut your costs so much without impacting the appearance and the performance of the property. So if you're able to cut your costs by 5 or 6 or 7%, that's typically a pretty good number. On the other hand, we're often able to increase our revenue by 25 or 30%. So if we have a choice between reducing expenses or improving the revenue, we're going to almost always move towards the revenue side and try and increase the revenue rather than the costs. Okay. So, the things that we try to do to improve the revenue, well, number one is, creating community and creating a place that when a prospect walks in the door or when they even drive up and see the property, they get the feeling of, hey, yeah, I could live there. So it needs to be welcoming. It needs to look good. The landscaping's good. The paint's good. As they walk in the door, it's got a warm feeling. They get welcomed by the leasing agent or by the management staff. As they walk around the property, we want everything to be right for that level of property. We want everything to be right from the moment that they drive up to the property, walk into the leasing office, walk around the property, and walk into either a model unit or the unit that they're going to live in. So, we want the bushes to be trimmed, the grass to be mowed, the grass on the sidewalk to be sharp. All the trash needs to be picked up. The leasing agent or whoever's doing the tour needs to be pleasant and nice and welcoming. But we want them to feel comfortable, number one. What I always tell our staff is 9 things can be right, but if only one is wrong, a renter may not know what that one thing is, but they'll sense that there's something wrong. So getting all of those little things right in the detail is really important. If we can get all those things right, then a prospect is more likely to say, yeah, I could live here, and they'll pay a premium rent. And that's what we're trying to do, is we're trying to get everything right when it comes to the leasing of the property to where they pay a little bit more than the competitors because they feel at home in the property. So that's number one. And again, that can be just simply having a designer, what we call a designer paint scheme, white ceilings and two-tone scheme in the walls, having that look sharp and clean. That's one of the key things to just outperforming in comparison to your competitors.
So I noticed you have properties all over the state: Midlothian, Waco, Lubbock, New Braunfels. So it appears that undervalued properties are not just in San Antonio, but spread throughout the state. Is there a certain set of neighborhoods you go to find these?
Well, we've said that we have an objective of being in a maximum of 5 markets at any one time. And so that might mean, for example, let's say San Antonio, Houston, Dallas. Those are 3 very distinct markets. And those are 3 markets where we're very established. We'll probably be buying a property in a 4th market and researching the 5th market at any given time. And as we see that the prices and the market values increase, we might sell out of a market for a period of time and look for the next market at that point in time. So as we moved into Texas, the 4 key markets in Texas are going to be Dallas, Austin, San Antonio, and Houston, and maybe not in that order. So we've been in all 4 of those markets at some point in time. What we've seen in Texas is that, number one, there's a lot of job growth. It's a great market for us. But if you look at the I-35 corridor from San Antonio all the way up north of Dallas. Maybe it becomes I-75, I think, north of Dallas. But that corridor has tremendous growth. I remember reading a market study at one point in time that 50% of the growth in Texas was focused in that corridor, roughly 20 miles either side of that corridor. And you can see, San Antonio, Austin, and Dallas sit all in that corridor. So, San Antonio, Waco, Midlothian, we have a property in Mesquite right now. Those are all markets that are strategically in this I-35 corridor. And that's why we've owned properties in those markets. I can come back and say, the Waco property, Waco was not a strategic market for us, but a property was presented to us that was mismanaged, distressed, and we purchased that property for a little over $6 million, put about $1.3 million of CapEx into it to fix it up. So we had about $7.5 million, something like that, into the property. And 2 years later, we were able to sell it for over $13 million. Now, that was an opportunistic purchase. And so, as I said, strategic, opportunistic. We will be opportunistic when we find just a great value that's outside of one of our strategic markets. But pretty much we're just looking for properties in those base markets that we like.
Now, from the time you started to today, the Texas market has matured. There's probably not as many undervalued properties out there today as there were 2, 3, 5 years ago. How do you find them today?
It's tough in Texas right now. It's nationally. It's tougher to find the types of properties that create stable, consistent and lower risk. There's always risk in an investment, but let me call it lower risk returns. So if we're looking for a high return and low risk, that's difficult in Texas right now. We were able to acquire a property last year in Dallas. It was an off-market property that was brought to us by in a relationship with a broker and with a seller that we previously bought a property from, and that was a great deal. But if we look at the properties that are marketed, that are published by brokers, there's so much demand in Dallas that there isn't anything that we've bought in the last year and a half or 2 years that's been a marketed property. They're all what are called off-market, or they're private sales, that type of thing. So in Texas right now, that's the only way that we're buying properties, because again, there are so many buyers out there and they're pushing prices very high. And in our opinion, they're pushing them past the point of making it a good value.
Do you see a correction coming up in the Texas market? Do you think the real estate market's going to take a correction back, given it's so overvalued?
Well, there's the million-dollar question. I get that question every single week. My answer is yes. I do think that we're going to top out. I don't think we're there yet, but I think we're nearing the top of the market. Now, how serious of a correction that's going to be, I don't know. I don't think it's going to be like 2007, 8, 9, where prices fell so dramatically. I mean, we were able to buy properties for 30 cents on the dollar. But I do think there'll be, at the very least, a pullback. And the reasons that I see that coming are the number of new properties that are being built is just starting to outpace the growth in demand. Demand is still really strong, especially in Dallas. Demand is strong, but the new construction, the new supply is even stronger. So if you look at the Class A properties right now in Dallas, you're seeing that it's taking them longer to lease up. They're offering more concessions. They're not hitting their targets. That's going to start affecting the Class B properties pretty soon. The Class C properties still have some room to grow, but they'll be the last ones that'll be affected by this. But that's one of the first signs that we see in the market. The other thing that we see in the market is we see everybody, including grandpa, grandma, mom and dad, and their uncles and aunts, getting into real estate. And traditionally, that's always been one of my dad's things, is that when everybody is going into the market, that's a sign that we're nearing the top. And I think that we saw that in 2005 and 2006. We're starting to see it now. So if you asked me for a timing, I'll throw myself out there and walk out on the end of the diving board or the edge of the cliff. I think that we have 12 to 24 months left of growth in the market. And then I think somewhere around that time period, we're probably at the top and we might be seeing some decline in prices.
Well, that's a good prediction, and I think a lot of people agree with you at some level with it. We're near the end of our time. Any wrap-up words you want to bring up that we haven't covered so far?
I wish I had another 20 minutes to talk, but this has been a lot of fun. It's always pleasant. We've had great returns. Happy to talk to any of your investor group personally, either by email or phone. You can contact me directly at Daniel@windmillinvestments.com. Our website is windmillinvestments.com, and my phone number, if you want to try and reach me directly, is 503-881-9748.
Well, great. We'll put that in the show notes to make sure people who want to get back in touch with you can do so. And we appreciate your taking time today and love to have you back in a few months to talk about how the market is progressing. With that, we want to thank you for joining us today.
Well, Hal, thanks a lot for the time. I appreciate the opportunity to talk to you.